Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back at the end of yet another week for another weekly market recap featuring my very good friend, portfolio manager Lance Roberts, who's looking a little peaked here at the end of the week. How you doing, Lance?
I went running today just before we did this, and it is hotter than hell in Texas right now. So it was brutal, the heat this morning. So yeah, I may be a little bit peaked here for a bit, still trying to recover my mojo.
God, I'm amazed you're even awake. I was talking with Amy Nixon, Texas runner, who's appeared on this channel a couple of times. I'm sure folks know her. She's a big runner, hence her handle there. She sent me the weekly forecast for Dallas, which is where she lives. And I think like 106 degrees was like the coolest day of the projected week. And she's training for a marathon amidst this. Just bananas being out there running in that heat. Don't know how you guys do it.
Yeah, well, she's better off than I am too, because I'm in Houston. We're on the coast, right? Versus Dallas, which is North Texas. So we've got humidity and then heat on top of it. So it's pretty much like a microwave oven when you're running.
Dude, have you just not heard of an indoor treadmill?
I do treadmill 4 days a week. So normally my workout routine, I kind of run a split. So 4 days a week, I do weight training. But before I do the weight training, I do 20 minutes walking at a 3.5 to 4 mile an hour clip at a 10 to 12 degree incline. So I do that indoor because that's all in my office. So I'm working in the office during the week. I go down, I train and do that on Fridays, Saturdays, and Sundays. You need some good vitamin D. D3 is one of your best vitamins that you can get into your body to help build and maintain muscle mass, collagen, etc. And you get that from the sun. So I like to get out on weekends and get some training in. Plus, running outdoors is just a very different environment than running on a treadmill in terms of building endurance and stamina. So I try to blend the two together.
All right. I'm there with you running outdoors, except there's some temperature and humidity point at which I think I might have to draw the line. But anyways, kudos to you. Audience didn't realize they were going to get a bunch of fitness tips this week. But there you go, folks. All right. Well, look, Lance, lots to talk about. Big news this week was the Federal Reserve announced another rate hike. That was very expected by everybody. We'll talk in a moment about implications of that and what Fed Chair Jerome Powell had to say in the presser he gave. But it's interesting, the markets have really tried to sort of shrug off this rate hike, which they have done all year, right? They've basically said, we don't care that cost of capital is going up and that the Fed's trying to slow the economy. We're going to keep pricing assets higher. It was interesting yesterday because the markets jumped aggressively at the start of the day. And then about midday, they just suddenly gave up the ghost. And I was wondering if that was sort of an important reversal moment. But here on Friday, they opened aggressively again today. So TBD, but we see a market that's trying to continue the trend of saying, we're discounting everything the Fed's doing. How are you looking at it?
Well, yesterday really had nothing to do with anything other than a kind of a fake headline that came out. It was Japan has been talking about and working on yield curve control now for a while, and they've been capping yields at 0.5%. Well, yesterday there was kind of I don't want to call it a fraudulent headline because there was actually the Bank of Japan on Friday actually did change their kind of yield control curve. They said, well, we can let the yields drift up to as high as 1% from 0.5% on the JGBs, which was far different than what kind of this headline that hit the wire on Thursday, which caused the sharp sell-off. It was just this headline was basically, it's like, Japan's going full yield curve control, et cetera, and it just kind of spooked the markets temporarily. And so you did have a fairly sharp intraday sell-off, but that was pretty much sorted itself out. And that's why on Friday, once the market got the real kind of data in on what the Bank of Japan was going to do, it was like, oh, it's a nothing burger, and everything reversed back higher. So, we didn't quite get back to yesterday's highs that we had at the open, but we did recover a vast majority of yesterday's decline.
Okay. Well, so in the short term, we'll see what's going to happen here, but markets now looking to close the week higher with today's, jump.
And we'll also close the month higher, which will put the S&P at 5 months straight of advances. And, historically, there's a 100% win rate for the rest of this year. When you have 5 straight months in a row for the S&P, the rest of the year is always positive 100% of the time. So again, the bullish momentum train is certainly, progressing here, and there doesn't seem to be much at this point, at least to derail it.
Well, and that's exactly what I want to continue to dive into here, where, last week you said, look, the bull case is a technical case, and technically things are looking really bullish, and you just gave further insight into how that bullish momentum is continuing from here. Perhaps contributing to that, and I'd like to get your thoughts on this. In his presser this week, Fed Chair Jerome Powell said something that I thought might goose the markets a bit, and maybe it is responsible for yesterday's initial jump and then today's strength, which is he was asked, because it's so interesting. On one corner of his mouth is talking about the lag effects, right? And saying that we haven't seen the preponderance of the impact of the tightening measures that we've been pursuing so far.
Sure.
But then he was asked about, well, what do you see as the likelihood of a recession here, Chair Powell? And he said that his base case, Chair Powell's base case, is no recession. That I as the skillful pilot of the ship of the economy, the airship of the economy, am going to be able to manage the softest of landings, right? And we know that the Fed, terrible at actually making its predictions come true. But he then said the Federal Reserve staff, which he says develops an independent forecast from, the voting execs, has now changed their models to now saying that a no landing is the most likely scenario going forward. So again, if we want to listen to the Federal Reserve is singing a very dovish tune about what's going to happen to the economy here. Like I said, the Fed has a terrible track record of actually manifesting what it predicts for us. But do you suppose that some of that news of, hey, we don't see that there's going to be a recession and we've changed our models is adding some of the levitation to the markets right now?
Yeah, no, absolutely. Because, again, this is what we talked about last year. The problem last year with the whole recession call, and has remained the call so far, is that everybody was expecting a recession in 2022. And, because of that, there was probably not going to be a recession, because if we had had a recession, it would have been the most well forecasted recession ever in history. Even the Federal Reserve was predicting a recession. So the fact that we didn't have a recession is actually not surprising, because of psychology and the way markets behave to expectations, and markets adapt to expectations, and everybody was expecting a recession. So the good news is, if you're in the recession camp and you're wanting a recession to occur in the economy, you've actually got a much better setup for it now, because now even the Fed has pulled back and said, hey, no recession. Goldman Sachs, no recession. The vast majority of the financial media and economists are now saying no recession. So now that everybody's out of the recession camp, if you're going to have this lag effect and if you're going to have a recession, you've now got a much better psychological case for that recession to actually occur. It's just kind of contrarian. It's the way markets work. And as we talked about before, if markets know about something, it prices it in and typically does something different. I would suggest, though, that because of all this monetary impulse into the economy, if you take a look at GDP yesterday as well at 2.4% growth, you've got a lot of federal stimulus still coming in. You still got a lot of money sloshing around the economy. So if we're going to have a recession, now that we've got everybody out of the recession camp, then it's probably going to be late 24, early 25, just because of the time it's going to take to work all that liquidity out of the market.
Okay. Yeah, we talked about this a bit last week, right? And a user actually provided some clarity, which is nice. So bull markets climb a wall of worry, right? And we talked about how at the beginning of the year, there was a big wall of worry. And certainly the S&P has climbed that wall, right? So the question was, what do bear markets do? We couldn't remember exactly, but apparently they slide down a slope of hope. So you're now saying that we're beginning to see some real hope come into the equation here, and that then provides the opportunity potentially for a bear market to happen. Not saying it's going to, just saying, you were much less comfortable about a recession occurring when it seemed like everybody was expecting it. Now that fewer and fewer are, maybe those probabilities increase. So Powell, the other thing that's notable that I took away from at least what he talked about is he did stick to his guns. And I got to say, I do commend Powell for how consistent and committed he has been since he started this hiking and tightening campaign of saying, look, I'm not going to finish until we get inflation down where it needs to be. And that means it's got to be at 2% or close to it. And we've got high confidence that it's headed there, right? So he talked about core CPI, which is still higher than headline CPI. It's not moving down quite as fast. And basically just said, guys, I'm literally not stopping until, I'm certainly not pivoting until we get inflation where we need it to be. They kept trying to kind of get him to predict whether he's done hiking or how many hikes he might still do from here. He refused to play that game and just said, look, I'm going to look at it on a month-by-month basis, and we'll just figure it out as we go along the way. He did say, I do not see us making any cuts in 2023. And he said, we might make some next year, but it is wholly dependent upon inflation being where we need it to get to. So, he is basically trying to continue to be really consistent with the markets to say, look, if you're betting all your hopes on a Fed pivot here, I'm still not planning to do that anytime soon.
Right.
Now we'll see how fast inflation continues to come down from here. As we've talked about recently, we actually expect it may tick up in the next couple of months just from the math of the base effects, right? As we head into next year, it's really just going to depend on I guess what the market data does there. I've got some additional thoughts on this I'll introduce in a bit after when we get to the point where I talk about my recent interview with Lacey Hunt. But I'm just curious, beyond his sort of, continued steadfastness that like, hey, folks, I'm not taking my foot off the brake trying to slow this economy yet. Did you take anything else out of that meeting we haven't talked about yet?
No, not really. I mean, you're right. And, the thing is again, he keeps putting out there that, the Fed will eventually cut rates, but you've got to ask yourself, why will they cut rates? We've been through this numerous times here on this podcast, is that the only reason they're cutting rates is because that recession has finally showed up. So when you take a look at the economic surprise index, that's been rising very sharply here. Obviously, economic strength remains fairly robust here as well. The question, and with inflation falling, that's gonna help ease some of the pressure on the consumer, and consumer sentiment has been turning up rather sharply here, which typically leads an increase in economic data. So because of that increase in consumer sentiment, we should start to see actual economic data improving over the course of the next couple of months, which is really going to be a conundrum for a lot of the more bearish outlooks going, well, where's the recession if you start seeing economic data improve? But that doesn't mean, again, that none of that precludes the fact that markets cycle and you're going to have this potential uptick in economic growth. And that's why I'm saying by the time you go through that, kind of this down cycle we've gotten very extended to the downside on this economic data. You're going to get a bounce in the data. And that's why I'm saying that next recession, talk is going to probably be somewhere late 24, early, mid 25, by the time you complete an economic cycle recovery and then have your next downturn.
All right. Interesting, because I'm sure we have a couple people whose heads probably exploded as you just said that. Say, wait a minute, this recession's now a year and a half put off from here. Do you think that's probable at this point, or is it too early to really?
Look, everything is, what I try to do is just put into place, the fact that we've got so much liquidity in the markets. Federal spending is ticking up sharply here. So, when you take a look at the amount of money that's coming into the economy through federal spending programs, et cetera, it's just going to delay the impact. We talked about this pig and the python, so many times it's almost funny now, but, it's just simply the fact is there's
eating a dead python. You're right.
Yeah. I mean, it's just there's so much stimulus out there. Again, student loan payments haven't restarted yet. And again, as we talked about last week and the week before, that's the one caveat out there that made, trip this whole thing up and accelerate that recession. But, a lot of economists are kind of writing off the restart of the student loan payments as pretty much a nothing burger. I'm not sure it is, but, the consumer is awful resilient, and we have to give credit to the consumer. They continue to spend, in the latest GDP report, personal consumption expenditures did decline from the last reading, but was still pretty strong. So, despite, all this talk about a recession and a slowdown, the consumer kind of keeps hanging in there, and at 70% of our GDP, that's an important part of it. So again, all I'm trying to just tell you is if your whole portfolio is based on this idea of a recession is coming, and I'm still getting a lot of emails from your viewers, they're like, I'm just really worried about, the economic catastrophe that's about to happen. And I'm like, what are you looking at? Because there's nothing out there that suggests an economic catastrophe is about to happen. Doesn't mean it won't, but it's nothing out there right now is suggesting that it's going to happen next week, next month, next quarter.
Yeah, I mean, I think we can find lots of points in the data to show certain areas that do look pretty grim. But then, to your point, there's other things out there that we can find data that shows, more robust strength. I do want to talk about the recent 2.4% Q2 GDP, because Lacey actually spent some time sort of dismantling that from his read. The vast majority of that, like 2% of the 2.4%, so 80% of the number, came from the auto industry. And it came from sort of the resolution of pandemic era supply chain issues. And it's not a repeatable boost. Yep. So you take that out, and all of a sudden, Q2 economic growth looks a lot less robust. But
No, it's a good point. And the deflator was a big, we had almost a 50% decline in the deflator, which was also a big boost to the GDP number. So, but the point is the number is the number, right? How we got to that number. And we have this conversation often, right? Every time we have a GDP number, we dismantle it. We say, okay, well, that's not repeatable. And then something else happens that boosts the GDP the next quarter. We go, well, that's not repeatable. And then the next quarter, we have something else that happens that's not repeatable. We have this over and over and over again. The point is to pay attention to the trend of the data, not the number. And so if you want to know if you're going to get into a recession, you've got to see the trend of that data begin to reverse. You're not going to have 2.4% growth in the second quarter, 2% in the first quarter, and then a negative 4% in the third quarter. That's probably not going to happen.
Yeah. Well,
again, not saying it can't, right?
Right.
There's never 100% anything, but just probability tend to stay intact longer than you expect.
Right. And again, this is beating a dead horse, or maybe a dead python. We talked about this
dead python for sure.
But you do a very good job of reminding us that yes, there's an ebb and flow here, and rarely do you get we wake up in the morning and the world has changed, and that people who put all their chips on the table expecting an abrupt phase change like that, whether it's on the bullish or the bearish side, tend to oftentimes get very disappointed, right? So your job as a capital manager, because you can't just have an opinion, you actually have to shepherd capital safely, is to, to a certain extent, listen to the tune that is being played. And while you're keeping your eye on the long-term macro picture, you're trying to actually dance to the tune that's being played so that you can make money for your clients. All right. So one thing I wanted to get your opinion on here, because I saw this chart right before we got to filming here, is we've had this big run up in the markets, right? Totally. That's just is what it is. A lot of people have made a lot of money who were long at the beginning of this year, and few people were long at the beginning of this year because sentiment was so bad and everybody was fearful that we were going to tilt into something even more catastrophic than what we saw in 2008. But in the ramp up here on the S&P, there have become a number of gaps up that have appeared in the chart. And so I'm just going to put up a chart here from Sven Henrik, the technical analyst who's been on this channel from time to time. He just put out on Twitter this chart of the S&P showing all these open gaps, and said that the S&P has become the market of unfilled gaps. And there's this sort of, old saying in investing or in trading that all gaps fill, or most gaps fill, right? So I know that you take TA into account in your work, Lance. I mean, how probable do you think it is that we go back and fill those gaps? Because if we do, we're talking about, I mean, I think the first one here in the chart's down at 38.75.
Yeah. So no, if you're going to fill the first gap, you're going to go down to 45.25, but then you've got to come down and retest support at 44.75 ish, which is the bottom of that next gap. So, each one of those, basically those gaps that you're going to have to fill are going to be support levels. And again, this is the one thing we keep talking about, is taking a look at the trend of the chart. You can draw a trend line across the bottom of those, most of those lows, and it's a nice 45-degree angle. But each one of those bottoms are going to provide support. Then, of course, if you overlay the 50-day on that, the 200-day moving average on that, those are both sloping positively now. So from a technical basis, you've got a lot of positive momentum in the markets. Markets are very overbought here, but each one of those levels are going to be providing support on the way down. Now, if you do fill a gap, that's not bullish. That's becoming more bearish in nature and suggests you're going to have lower prices. But again, as you keep coming down, you're going to keep hitting levels of support to where buyers will start to step into the market. And this is always the issue of a market itself, is where are the buyers and where are the sellers? Right now, there's always view the market like two rooms, right? So go sit in your living room, right? And you're sitting in your living room, and on one side, you've got one bedroom, and on the other side, you've got another bedroom. So in one bedroom, you've got all people wanting to buy stocks. In the other room, you've got all people willing to sell stocks. Right now, there's very few people willing to sell stocks. And the reason the market keeps going up is because there's a whole bunch of people in the buy room going, I want to buy stock, right? I mean, bullish sentiment, the National Association of Investment Managers is now over 100% long in their portfolios. And they have a terrible track record of being, a contrarian trader. So whenever they have over 100% exposure, that's typically near short-term market peaks. You typically get a 3 to 5% correction. They come bailing out of the market, and it's a good time to buy again. But right now, all those professional managers are sitting over there in the buy room going, I'll buy stocks. And the people that have stock to sell, those few people, are going, okay, I'll sell my Apple shares to you, but you're going to have to pay me $3 more than what you paid me yesterday for those shares. And so one of the buyers says, okay, I'll do that. And so $3 higher, those shares get sold. So one buyer leaves, one seller leaves. Now there's even fewer sellers. And the next seller goes, well, if he got 3 more, I want 6 more. And so a buyer eventually step up and pay 6 more. That's why prices trend higher. Now, eventually at some point, the buyers are going to go, I'm not willing to pay any more than this. And the seller is going to go, I'll sell you my Apple shares for $2 higher. And there's going to be no buyers there. And then, okay, how about $1 higher? No buyers. And then he's going to start going, okay, I'll tell you what, I'll sell them at $1 discount. No buyers, $2, $3, $5. And eventually that's where you start finding these support levels in the market. That's all the market's telling you, is there's some level here where prices will start to discount, and buyers are going to sit back and they're going to go, okay, I'll buy it at that price. And then that's where buyers will step back into the market. And that's why you have these resistance and support levels in the market. Resistance is where sellers fail to find a buyer. Support is where buyers find sellers again. So, that's how the markets that's how markets work over time. And that's why technical analysis is important. That's a really simplistic explanation of the market dynamics, but you get the idea, is that what you're looking for is a pullback to a level to where buyers will step in and they say, that's enough of a discount for me to start buying that stock. And that's what you're looking for, is good entry points for markets.
Okay. Yep. Good lesson. I'm going to ask my question again, though, which is, as an experienced investor, how concerned does that number of unfilled gaps here, given that the market's risen so far so fast? Does it worry you, or not so much?
No, it really doesn't. On the way up, you're going to get gaps higher. And you can go back in history and look at this. What you're looking for is a gap down that doesn't fill. And if you have a gap down in the market and you gap down 2 or 3%, and then you rally back 1.5% and don't fill that gap, that's bearish. That's where you want to start becoming much more concerned. And if you take out that low of that previous gap down, then you really want to become more concerned. But until you start seeing gaps to the downside, gaps to the upside is very bullish. That's just part of the trend. But gaps to the downside, if you start seeing those show up, that's much more concerning.
Okay. All right. Well, look, I now want to get on to the topic of the lag effect, because last week we said we would make this week's video focus on the lag effect. We
promised to do it. Yes.
Yeah, and what's interesting is, you're singing a chipper tune, and to a certain extent, that's your role in this weekly recap is to just make sure that we don't get too wrapped around a lot of the concerns that many of the speakers raised on this channel during the week. And again, it's not because I'm seeking out people who are quote unquote perma bears. I'm just bringing on analysts, and still the preponderance of ones that come on are concerned about the macro data. I have gone on record, though, personally saying that I think the lag effect is the single biggest, the single most important / most ignored factor in the economic soup right now. And I very well may be proved wrong. Time will tell. But basically, we're talking about, all of the efforts that the Federal Reserve and the other world central banks, or most of the other major world central banks, have been taking to slow economic growth. And we've spent a lot of words over the past many months explaining to people what the lag effect is and how it works, so I won't rehash it all here. But you just said yourself earlier, a lot of people are like, I've been hearing about this stuff forever, and the Fed's continuing to hike, but everything looks great. Markets are up, unemployment's low, 2.4% GDP, inflation's coming down. Guys, this is the Goldilocks world, right? So the big question is the lag effect going to matter or not? So, my thoughts. What are yours?
Yeah, it's going to matter. Look, it's fun. What's really funny is two things that have happened over the last, I guess, really 6-7 months, ever since October, when you and I started talking more about being bullish on the markets, because.
Yep. And to give credit where credit's due, you were doing the majority of that, talking about things getting bullish.
Yeah. And what's funny is that, I get all these tweets and stuff like, Lance has gone full bullish now. It's like, no, I'm really not. Personally, I'm still very bearish on economic data, fundamental data. And if you read my articles that we post on our website, you'll find plenty of really bearish ones up there. Talking about economic data. Today's macro view blog on our website is $32 trillion in debt and why it matters.
Yep. And we're going to get into that, just FYI.
Right. Well, I'm just saying is that, there's, everybody thinks I'm just gone full. Look, the markets are bullish, period. Argue with me if you want. They're up 18% this year on the S&P. That is clearly bullish. And the trend, go back to show your chart from Finn Heinrich. It's clearly a bullish trend. I mean, you can fight it. You can argue with it. You can throw sticks at it all you want. But it is what it is. But to the economic data and the lag effect and all these type of things, yeah, it's super concerning. The lag effect is real. You're going to have to pay a consequence at some point for higher interest rates, which are going to impact consumption through the consumer. And again, that's why I keep going back to the student loan repayment, which is giving people an extra, $200-300 a month to spend that they wouldn't normally have because they were making student loan payments. So when those start back up, immediately these households are going to have an immediate cut of up to 5% of their income for this restart of student loan payments. That's important, right? And that's going to certainly weigh on this. But we've had so many anomalies and this is the thing that we keep going back to. When we're talking about the lag effect, we're all looking back at history and we go, well, look, every time the Fed's hiked rates, then you've had a recession within 6 months, 9 months, pick your time frame, right? Every time the Fed has done this, you've had this outcome historically, going back throughout history. This time is not the same, right? Yes, the Fed is hiking rates, but you forget the Fed is hiking rates with $5 trillion in stimulus, $1.7 trillion in Inflation Reduction Act, numerous other spending, a Federal Reserve that was doing $120 billion in QE, expanded their balance sheet by $3 trillion over the course of just a year and a half. They're just now they're reversing that. Yes, they're doing quantitative tightening, but at half the rate of what they were expanding it. So, this is going to take time to get all this liquidity, this monetary stimulus out of the system, because it just doesn't evaporate. It's got to work its way through the system, and it's going to take a long time. And so the lag effect is real, but the lag effect may take substantially longer than anybody is expecting. We keep expecting this to show up, and hey, I'm guilty too. I wrote articles last year talking about, we're going to have a recession in probably late 23. Everybody was expecting a recession last year. I said, we'll probably have a recession late 23. We're not going to have a recession this year. It'll probably be 24, 25. It's going to take time to work all that out. So the lag effect is real, but it's getting really delayed because you had this tidal wave of liquidity that's helping support economic data.
Very good explanation. And one element I want to add to that too is there are counterintuitive trends going on that actually make things look better in the near term, that I think give people a false sense of security that we're through it all. That like, oh, 2022 is over, guys, right? We took the pain. Now we're through the storm. Everything's better, right? And I've been mentioning this on the channel the past couple of videos, but I'll mention it here again, Lance, because I'd love to get your thoughts on it. In the past, when the cost of debt, when interest rates have gone up, making the cost of debt higher, you have seen the net interest expense percent for corporate income statements increase, right? They're having to spend more on debt. And so your interest payments go up, you have less money left over, that eats into your profits, your corporate profits go down, right? So that's what you normally expect to see in cycles like this. Instead, right now, we've been seeing the opposite. And I just want to share my screen again here. Can you see this, Lance?
Yeah, my good friend Albert Edwards from SocGen produced that chart, and we talked about it recently on both our radio show as well as in some of our daily market commentaries. What's important about that chart, and again, what he's saying here is that normally you should see a pickup in net interest expense, but if you go back and look at some of these other periods, what you'll see is there's a lag effect to that to a degree. And so,
and just to be clear, that's why I'm bringing it up here, because it's instructive of the lag effect argument. But go ahead. Yeah.
There's a lag. There's a lag to where that interest payment goes up, and because think about this, corporations financed a whole bunch of debt at very, very low rates, and now that there's no reason to refinance that debt because debt's very low at this point. So right now, you're not seeing that big increase in their balance sheets yet. And again, there's a lot of problems with the small and mid-cap companies, but that's a very small percentage of debt compared to the amount of corporate debt held by major corporations like Boeing and Apple and Microsoft, et cetera. So when you start to take a look at the magnitude of the debt, just a lot of that debt was financed at low rates. When that debt starts to reset, you'll start to see that net interest expense go up, but it's too soon right now because we don't have a lot of debt. We don't have a debt wall or debt maturity wall coming up in the next few months. Probably 25, 26, we'll start to see that net interest expense rise as debt gets refinanced at higher rates.
Yeah.
Assuming rates are still higher when we get there.
Right. Yeah. Presumably if the Fed had a mega pivot beforehand, these companies might make it through the worst of these high interest rates. But if they don't, and yes, there's a lag effect, although I do think you look at this chart, you don't see a pronounced divergence anywhere near like this, right, in the past 40 years, right? But what this says to what Lance was saying is they have this great kind of Goldilocks moment right now where they haven't had to roll over their existing low interest rate debt, and they're making a lot more money off of their cash balances. So great. So everyone, can look at the short-term data and say, well, companies are doing great, right? But with the lag effect, if indeed when it comes time for these companies to have to refinance because their existing cheap debt matures, Lance, they're going to be refinancing if rates, let's just say, hang out where they are right now, at twice the cost of debt. Yeah.
Well, also too, think about here's the other, the other issue going on right now is that companies are sitting on a boatload of cash. We talk about this, $5.5 trillion worth of money in money market funds. Very small amounts of that, very small, is retail money market accounts. The vast majority of those money market funds are corporate balances, and so a lot of companies are sitting. Talk about Apple as an example. they've got 130, 150, I don't know what the number is right now, but it's like 150 billion in cash on their balance sheet. Apple was taking on debt at low rates to do share buybacks. So they were going, okay, look, I can buy back my shares and I can increase my share value by this, and I can borrow super cheap and write off the interest expense to do that share buyback. That makes sense. So that's a good use of leverage for them. I don't think it's a great idea, but it is for them. And so they took on some debt. They could pay that debt off at any time. Apple doesn't need to issue debt, right? So that's part of this. Is a lot of these companies are sitting on so much cash, paying 4% and 5%. There's no need for them to go out and issue debt right now. So that's another reason why we may see that suppressed and see net interest payments start to go up somewhere in the future.
Okay. Well, it'll be super interesting to see again what happens from here. But again, this is to my, I think, overall point here, which is we know that as long as the cost of capital stays this high, that is, these companies have to then go out and refinance, and a lot of them will, right? Not every company is an Apple just sitting on a total war chest here, right? Yeah. That we're going to see corporate profits start getting hit by that, but people are sort of short-termers, and they just look at what's happening right now and they project that what's happening today is just going to happen out in the future. So you get this sort of, again, this sort of false promise of what tomorrow is going to look like. So if indeed the lag effects arrive, if you and I are correct, there may be a lot of people right now that are making bets on the status quo that could get very disappointed down the road.
Yeah, no, and look, Albert's work is spot on. He does great work, and his analysis is absolutely correct. The only thing that we're all trying to process, and that none of us have the answer to, I don't, nobody does, is how long, because again, think about this also, right? Let's talk about unemployment for a second. In a normal economic environment, right, we're hiring people and we've got, employment at such and such level. So we're 95% employed. We've got, 5% unemployment, pick a number. Now, in a normal environment, the economy starts to slow down. Everything, companies go, okay, they're last to hire, last to fire. Companies wait a long time to hire people. They want to make sure the trends are in place. It's very expensive to hire and train somebody. So I really try not to lay off and fire people unless I absolutely have to. So they're last to hire, last to fire. So in a normal environment, the economy starts to slow down. As the economy starts to slow down, then we start laying off workers and unemployment rises as you head into a recession. The difference this time is that in 2020, we just shot a hole through companies and told them, look, nobody can come to work. So we laid off half the labor force, right? So now all we've done is basically hire back to where we were in 2019, pre-pandemic. And so if you start looking at normal workloads of companies and say, okay, I'm normally producing this and I've adapted to this hybrid environment, et cetera. So I've got less workers than I used to have. My labor force is cleaner than it used to be. There's not a real need right now, potentially, for a big round of layoffs because I never really hired back everybody I had. And again, in a normal environment, I tend to hire people back and then overhire. We saw a bunch of layoffs last year. And mostly in tech companies that were just they were just hiring people as like, hey, we need people to monitor social media, right? So they just hire a whole bunch of people to do that. They were really just unproductive. And so we saw a lot of layoffs in the tech industry, but in the rest of the world that is very much more balance sheet, income statement conscious, we saw them hire back, but they were tentative as they were hiring back. So there's not a lot of excess labor to go lay off. So we may not see this big rash of layoffs and firings and terminations because of what we did in 2020. We kind of screwed up the normal cycle of the employment. And so that's another one of these issues. Again, as we go back and start talking about this lag effect and why this time is different and why things aren't occurring as fast as they should, is because we had this whole big anomaly in 2020 of stimulus and shutdowns and all this that really sucked a lot of the normal recessionary tinge out of the economy and never really fully came back. And so, there's a lot of reasoning why this time is different because of what we did in 2020, which was not a natural, organic driven recession.
Yeah. So I totally get that the pandemic era was full of all sorts of unnatural things that we had never seen before, and things that we probably never should have done too. But anyways, it all happened, right?
Right. And so screwing up and my point is, it just screwed up the economic data.
I get it. And I think this is an important point, which is that there's so much sort of new dust in the air that's kind of clouding everything, that we got to be more cautious than normal about predictions that we're making, because there are things that are new this time. I do think, though, that
eventually it'll all work itself out, right? Eventually we'll get back to normal. It's just, you got to deal with this.
Yeah. And I guess what I'm saying is, and this is me sharing my personal bias here, which is, if you want to take the contra argument to the folks that think a recession is coming for all the many reasons that we and many other experts on this channel have discussed, then you really have to have a data supported and really well-reasoned rationale for why it is different this time, right? Mm-hmm. And you just gave an example for how it could be on the employment side of things. I don't necessarily see that it going that way for some reasons that we've discussed in the past. And if you look at the employment data, you actually are seeing a lot of erosion there in the leading indicators that you expect to see fall first before the rest of the employment market hits. And if you're interested in learning more about that, go watch the video that I recorded a few weeks ago with Eric Basmajian, where he gets into that data specifically. But I want to mention something that Lacey Hunt mentioned on this topic, Lance, which is we talked a fair amount about productivity and the importance of productivity, worker productivity. And Lacey basically said, like, that is kind of the metric, right? As the productivity of your workforce goes, really so goes the trajectory of your economy. And his conclusion was that worker productivity has been on the decline for a concerning period of time now. And he says, look, the only way that gets right-sided at this point is by a rationalization of corporate workforces or labor forces, which is sort of diplomatic economic speak for layoffs. you got to rationalize the cost of the labor versus what the output of the labor is right now, and that's been declining. And the only real way that
that's not really layoffs. That's not what he means.
Well, look, I dug into it with him, and it did mean layoffs. He did expect that layoffs were going to happen.
Yeah, they will have, the layoffs will happen, but if you're going to right size your workforce to increase productivity, you're not going to like the outcome of that, right? And because that means fewer workers that are producing more at a better cost structure, and that's lower wages. And again, what we've done to our economy over the last 10, 20, 30 years, productivity has been declining since 1990. Right? This isn't something new. This didn't just show up since post-pandemic. It's like, oh my gosh, where'd all the productivity go? Productivity has been declining on a per worker basis for a long time now because of the changes to the technological workforce that we're doing and the fact that we're outsourcing most of our labor to other countries. Hey, Lacey's absolutely right. You're just not going to like the fix for it. And he's absolutely right about that too.
I agree. Yeah. And sorry, just to put some numbers to what you're saying. He said that real GDP per capita from 1870 to around 2000 averaged around 2.2%.
Mm-hmm. Yep.
From 2000 on, it's dropped to 1.3%.
Yep. And it's going to get worse.
Yeah. So, yeah, look, I'm not saying anyone's going to like this. I'm just saying that this was Lacey's sort of inescapable, like, I don't see how we avoid this. It's going to have to be rationalized through.
Right. No, and look, and I agree. Okay, you're talking about two different things. What he's talking about is a long-term solution to fixing productivity, right? And that's something that's got to change. If you're going to have, let me back up. Pre-2000, really pre-1980, our economy was growing at 6 and 7% rates of economic growth. Since 1980, because of all the debt and everything else we've been doing to the workforce, et cetera, since then, wages have been declining. The profit per worker has been surging. This is when we have people complaining about the disparity in wages between CEOs and the workforce. And we've done all these things. Share buybacks are part of this issue. Compensation structure is part of this issue. The shift of pension liabilities off to the worker through shifting everything into a 401k plan and say, hey, you're responsible for your own retirement, adds to that whole problem. So, the reason that we can't have higher rates of economic growth and the reason we can't sustain a higher rate of inflation is because of all the debt and because of the economic disproportionate wealth structure within the economy right now. So what he's talking about is absolutely right. This is a long-term problem that's going to continue to get worse. What you're talking about is, we're going to have a short-term recession and we're going to have layoffs go. That doesn't fix the problem that he's talking about.
Oh,
right?
I agree.
Two very different issues.
There are two separate but related issues here, right?
Exactly.
There's the big macro one that you're talking about, right?
Yep.
And we are going to still get to your piece that you wrote about the debt and why it matters and why it is dampening our long-term prospects. But we're talking about the relatively near-term acceleration and decline of productivity, if you will, since the pandemic. And that is what he was saying is more in the short term. He expects to materialize in the next recession. We're gonna see those layoffs because they need to happen to save what will be happening to corporate profits.
Yeah, absolutely, and that's where you're going to see a big influx of And look, Google just recently is working on signing a deal with the New York Times and the Washington Post to have their AI write news articles. So how many jobs are now going to get lost to AI in the next? And again, this has been part of the job loss structure we talk about is this implementation of technology, where less and less people are needed to produce the same job. I do a radio show every day. I've been doing a radio show for almost 23 years now, every day. Back in 2000, it took about 6 people to produce that radio show, and that was no video involved. That was just simply getting the thing on the air. Yep. There was a producer, there was a director, there was a board operator, there was all kinds of all these people. Took 6 people to get a radio show produced. Today, we produce audio, video, the whole 9 yards with me, the host, and one other guy.
Yeah.
Right. And so 5 people lost their job to technology, and they're never coming back.
They're never coming back. And that's pre-AI. And look, the positive flip side of this, it's a great time to be an entrepreneur, right? You can do things that we would have taken an army of people in previous generations to do for you, right? The shadow side of that same coin is the fact that tons of people aren't needed anymore, right? And we've talked about this, Lance, which is we have created a terrible malincentive in corporate America to shed as many real people employees as you can, right? We've made the cost of employing people so high for employers, and it really is felt in the small business side of the world, right? Yep. Where it's everything from rising wages, rising minimum wages, and I'm not. Look, I know it's nearly impossible these days to live off a minimum wage, but if you get a smaller employer who's already got pretty razor thin margins, when you lump into health insurance and OSHA and just all the things that come on with employing people, and the fact that it's a risk employing somebody, right? You hire them and then they might walk out the door 2 weeks. They might not work out, right? You invest in them and they just don't show up. Whatever. There's all sorts of issues. There's lawsuits and legal concerns and all that type of stuff. So we've made it really painfully expensive to hire labor, and up until recently, we kept the cost of capital so cheap that it was pretty cheap to borrow to invest in automation and outsourcing and all that type of stuff, right? And now with the technical advancements, both in robotics, general software, but now AI exploding onto the scene, there's this increasingly sweet siren song for businesses to say, how can I get as much of this stuff done with fewer people than I have, right? So that's a bad societal thing. And I want to tie this to an interview that I just recently watched between Jeremy Grantham and David Rosenberg. And Grantham, as he does, his expertise is in asset price bubbles. And so, most of the interview was opining on the great bubbles of the past century and how he believes we are living through the bursting of the last great bubble and what he expects to come going forward. And spoiler alert, it's not very good. But he concluded by basically saying that his perhaps bigger concern here is that the real crisis that unfolds from the bursting of this latest bubble may not be a financial one, that the real crisis may be a social one, that we have just turned the screws on labor for over a half a century, where the past 50 years, labor has lost out to capital, and the benefits of the prosperity that the economy and society has gained has gone so disproportionately to those that have capital and own the means of production, and that labor has gotten increasingly squeezed. And if you look at things like real wages and the growth and net worth of the bottom 50% versus the top 1%, all that stuff, you can just see that labor has just been getting screwed. And his fear is that it gets to a point finally, and maybe it takes AI just vaporizing, huge swaths of the economy that low level or, entry jobs or just, regular blue collar jobs take, for enough people to finally just say, enough, we can't stand this. And then you get some sort of social revolt. Not entirely sure in his end how that manifests, but he says it's something that keeps him up at night.
No, I mean, it's look, the problem that you have is wages. And again, you have to really separate stuff out into kind of reality versus fantasy land. I call fantasy land Wall Street because, where do you find this abnormally high discrepancy between the CEO pay and worker pay? It's in publicly traded corporations where your C-suite executives have stock options. They're granted these things. And they, of course, then, and I just wrote an article last week talking about how companies beat earnings estimates and how CFOs have admitted to fudging up to 10% of their accounting to generate these earnings for the reason of stock-based compensation. And so, you have this disparity that occurs in the real world. And this is your guy that's down the street running a small industrial machine shop, or, the guy on the corner running a convenience store. In the real world, that disparity between the guy that owns the shop and the labor is not that big.
Absolutely.
And so
oftentimes it's that owner who's like basically not taking a salary many times just to keep the business afloat, right? Yeah, exactly.
Right. And so the problem is that we lump all this together. And it's just like anything else. You take a look at the top 1% of income earners, right? And they have this massive disparity of wealth. And this is why you can't look at things. There's a lot of data that's put out by the government. It's like, okay, look at debt to income ratios, look at savings ratios, and look at these different, whenever there's a ratio, you need to take it and throw it out the window pretty much, because the vast majority of the top 10% of income earners that have all the wealth, they have no debt, right? But that skews all those ratios to a big degree, because if you strip them out, all of a sudden it becomes much more proportionate with the rest of the economy, because the rest of the economy is pretty fairly well balanced across that. It's just what's happening in this kind of fantasy world we created. And that really started in 2000 when we changed, compensation for executives and all these other types of things. So, is there a problem? Absolutely. Does it need to be fixed? Yeah. How are you going to do it? You got to start with getting rid of stock-based compensation. You get rid of stock-based compensation, you get rid of fudging of accounting statements, you get rid of all this other stuff that goes on to manufacture and manipulate earnings to beat Wall Street estimates. And then you can kind of probably get back at some point to actually having fundamentals matter for companies. But, the rest of the world is just really struggling to make ends meet, because the economy is growing at 2%. That is not strong enough to generate massive amounts of economic prosperity. And that's
here's the question that I think Grantham asks, and I don't know the answer to it, which is, I agree with you, Lance, that's where the reform needs to start.
Yep.
Is the reform going to start there proactively, or is it going to take some sort of social revolt to force it?
No, I don't even know how you force it through social revolt, honestly, right? You can show up with pitchforks and torches, but until you get Congress, until you get the Senate, until you get Wall Street to all agree, basically, to change the compensation structure, because this is all that's got to be legally mandated, right? You've got to have Congress pass a law that says no more stock-based compensation. That's what Bill Clinton did back in 1999. He thought he was going to try to fix this problem. So he says CEOs can't make more than $1 million in salary.
Right. And they just found a whole way to end run
okay,
around
great.
it all. Yeah.
No problem. We'll do stock-based compensation. That's even better. So, you got to go back to saying, look, you can't have stock-based compensation. You can't do these things. Your CEO has to make a salary. And look, if a company, let's pick a company, Apple. If you told me that you were going to pay Tim Cook $50 million a year to run Apple, I would probably say, okay, it's a $3 trillion company. That company just pumps out revenue every single year. Can I justify him paying, could the board justify paying him $50 million a year in a salary? Probably, right?
Right. The Apple CFO could shake the couch cushions at Apple and come up with 50 million. I mean,
yeah. So, but as soon as you go back to salary, right? And so this is the important thing about salaries. All of a sudden, if you start paying salaries, that shows up on the earnings statement, right? Because that's direct deduction from the revenue that comes in. So if a company earns $1 million in sales, right? You have sales of $1 million. And the CEO of the company is really greedy. So he says, my salary is $1 million. Well, now all of a sudden, 1 million less 1 million, you've got $0 to work with to pay all the other expenses in the company, right? So there's no way to pay that salary of $1 million to a CEO of a company only making $1 million, right?
Right, and let alone distribute anything to shareholders, right? Yeah,
absolutely correct. So all of a sudden, you go back to just salary-based compensation for everybody, right? The company can only pay out so much. And there's only so much that can go to the CEO of the company based on the profitability of the company to deliver shareholder value at the end of the day, which is their job. So again, this is the only solution is to go back to purely salary-based compensation. It'll never happen because Wall Street makes way too much money on stock-based compensation measures. And well, since Congress and the Senate are bought and paid for by corporations to pass bills and lobbies and everything else and fund PACs, they're not going to change it either. So it ain't changing, but that's the only way to fix it.
Yeah, it's probably not. Just to go back to Grantham's for a second. So he talked about how Schumpeter, the economist, warned, about a century ago that capitalism could become too successful, where you end up with this captured system, right, where the companies that succeed the best reinvest the proceeds of their advantage back into the system to get even more advantage, right? And you end up with a bunch of, industrial cartels that have, bought the government and bend the government's rules and regulations to their bidding. And as he's talking about this,
but that's not capitalism. That's not capitalism. That's corporatism.
No, but as he's talking about this, it's like, hey, that doesn't sound too different than kind of where we are right now, right? You and I have talked about this. We've got corporatism or crony capitalism or however you want to define it, right?
However you want to define it, but that's not capitalism. Because capitalism is you, right? You started this podcast. You're creating a business. You're taking advantage of capitalism. Every little small mom and pop shop around this country. My wife and I went out to dinner the other night, and this new little bakery opened up around the corner from our house. It's called Tiny's Bakery. And it's a walk up. It's not even a restaurant. It's just a walk. They have a slide open window. You walk up, you get coffee and cookies, donuts, whatever they have. So it's cute. It's just a really cute little front that they've got going on. It's a great idea, great concept. Man, line wrapped around the building for this. Capitalism. That's awesome, right? We should have a bunch of Tiny's bakeries all around the country participating in capitalism. It gets screwed up as soon as you take that company public. And that's where all the evil begins to happen.
Right. Okay. So two things. One is this constriction of unbridled capitalism, right, I think Schumpeter's fears are largely getting realized today, right? And then what results from that is things like massive wealth inequality, like we've been talking about, where labor's been getting crushed, and that's probably only going to get worse going forward at current trajectories. So I agree with you that none of it is going to change proactively, right? The folks that are running the system and controlling it, they have no incentive to do this, right? And I think they're almost I don't think it's as guys who meet every week behind closed doors and rub their hands together saying, oh, how can we take over the world even more this week? But it's just human nature. It's just the greed and drive to have more, right? And so it almost acts like that in effect. It's just going to keep continuing until we get to a point where societally enough people just say, whatever, we can't keep the status quo going because it's just not working for enough of us, right? And I don't know how it's going to manifest. We saw one extreme example of that last year in Sri Lanka, right, where just literally the entire country basically showed up at the presidential palace and said, dude, you're out. We don't have a plan for what comes after you. We just know we don't want you, right? I'm not sure exactly that would happen here, but I could see us getting to a point where they elect somebody kind of like a Bernie Sanders type who's just, who's just a total dark horse, different type of candidate, and say, you have this mandate, you have got to deal with this. And that guy comes in.
And that's
now one person might not be able to affect that much change, right? But maybe it becomes a political movement and they get enough senators and congressmen that finally wrap around this. I don't know. I'm not trying to sling Pollyanna sunshine here. But
there's only one way
that would be preferable to something even more bloody. Let's put it that way.
Right, yeah. But look, there's only one way to fix it. You've got to get corporations out of politics, right? Corporations can't contribute to political campaigns. They can't run PACs. They can't have lobbies. Look, the Constitution is pretty clear. Americans vote for their representatives, who then go to Washington to vote their constituents' wishes, right? That's it, right? The only people that should have a voice in politics is the people, right? The individuals, the people that live here, the citizens of the country. They vote, they send their best candidates to Washington to vote what is best for them and the things that they want. See, as soon as they go to Washington, though, they get lobbied and bamboozled and taken out to 5-star dinners and lavish trips and private jets, all paid for.
Yeah, the Borg of the swamp just assimilates them. Yeah, exactly.
Yeah. And they forget who they're there to represent. You've got to get rid of corporations. They've got to get out of politics. Period. No contributions, no donations, no PACs, no lobbies. So if you're going to run for office, you've got to go door to door down your street, and you've got to raise money for your campaign from the citizens. And if you can't do that, you don't get to run for office, because obviously you're not telling them what they want to hear. But that's the only way you fix it. That's never going to happen either, because again, it's like term limits. Everybody goes, "Oh, we need term limits in Congress." Yeah, we do. What congressman is going to vote for a term limit?
Is going to vote for it. Yeah. No, I get it. And look, I'm with you where it's not going to change in and of itself. And I just wonder, do we just become the perpetual serfs of the top 0.1% forever, or is there some sort of massive breakdown in the system, or enough pain where enough people, stand up? We have a massive new political movement to get corporations out of politics.
Historical cycles.
That's above my paycheck, and honestly, folks, I spent more time on this in this video than I intended to, but hopefully that was interesting. Okay, we got some important things to get through. Not a lot of time. One thing I do just want to talk about real quickly, Lance, because in typical Lance fashion, you opened your mouth last week, and a lot of comments resulted in the comment section. You were bashing
probably
a policy of the current administration. And we got a lot of people saying, hey, Lance is super partisan, you shouldn't make these things political. I totally agree that this is intended to be a nonpartisan series here. The whole platform here at Wealthion is very intentionally nonpartisan. That being said, we have to make political comment. We have to comment on political developments that impact the economy. That's just part of what comes along here. And I'm going to put words in your mouth, and feel free to change them, Lance. But I believe you're like me, where you're just very comfortable calling a spade where you see it. You see a lot of spades on both sides of the political aisles. You're not pushing any sort of political ideology here. Yeah. The factor being is the administration that is currently in power is probably going to get the majority of the slings and arrows, just because they're the ones that are making the current decisions and creating the policies that we're reacting to in real time. But I know you and I have railed about many perceived injustices of policy that we've seen over the past bunch of decades, whether it was the bailing out of the too big to fail culprits that caused the global financial crisis, whether it was all the QE support afterwards and the buying of the MBS that rewarded all the the speculative real estate players, whether it was unfair tax breaks to the wealthy, whether it was the crazy amount of stimulus that was given blindly through PPP loans and other programs during the pandemic that resulted in billions of wastage. There's just, we can point to all sorts of developments that have happened across multiple administrations and blame them all equally. So I wanted to give you a chance to write the ledger here, that you're not pushing just one side of the political spectrum.
Yes, I am. I am pushing one side. No, I don't care about who's in office. It's about policy at the end of the day. Look, I rail equally on both Republicans and Democrats. So if you have a bad policy, I don't care what your political leaning is, it's a bad policy. And there's a ton of bad policies that are going on right now that are not helping you. And they're not making things better, and they're not going to make things better. And I don't even know what I bashed about last week, but you have to remind me whatever it was. But it's probably bad policy, and that's why I was bashing on it.
Okay. So let's bash a little bit more. Well, it's not necessarily bashing, but it is talking on a policy issue. And I can't remember if this is the one that caused the kerfuffle.
Oh, so you don't know which one it was.
I can't remember. I think you mentioned the name Biden. I think that's what set people off, where they felt like you were kind of anti-Biden, where I think you were literally just.
I'm anti every politician. So yeah.
And I know you, and that's why I wanted to do this.
Yeah.
But I want to pick up a thread that you mentioned earlier, which was the impact of student loan repayment, right?
Yep.
Because you have said multiple times on this channel, I just wanted to give you a little bit more time to talk about it, which is like, hey, that's actually one of the things that is on the horizon. It's not a black swan. It's one that it's a swan we can actually see. But if that thing comes home to roost, that actually could be a material factor in souring the soup here and really beginning to put the economy on a trajectory that could make a recession more likely here. And as I let you react to that, let me just give out some top level numbers here. So it's approximately 40 million borrowers out there for student loans. Total outstanding student loan debt right now is 1.75 trillion. The average debt is somewhere between, per borrower is somewhere between $30,000 to $35,000. 92% of these loans are loans to the government, and you and I have railed in the past of why. And this is actually what started the kerfuffle last week, because it was a policy that was actually done under Obama, which I think you mentioned by name, and it was that's when this policy came in place, which is
right.
The secondary education market. The preponderance of loans were made by private lenders in previous generations when you and I were going to school. Now it's been almost all taken over by government lenders, and that has created, surprise, surprise, you get government involved in industry, and, it creates all sorts of distortions and deformations. And what it did is it basically brought in a blank check lender that gave institutions the incentive to raise fees as high as the market would bear, right? And lo and behold, we have this massive, crisis of way too many borrowers with way too much debt. 50% of those borrowers, when we go into repayment, will have to pay at least $200 a month. 20% will be paying at least $500 a month. I think if you sort of take the average payment, it's somewhere in the 300s. And I think that's commensurate with the numbers that you were mentioning earlier. And so it's estimated that when we go into repayment, that will be about a $70 billion hit annually to consumer spending.
Yep. Well, I mean, if you just do simple math, right? 40 million, let's use really simple numbers, right? Because I don't have a calculator in front of me. 40 million borrowers, $300 a piece. That's $12 billion a month, right? By 12 months, it's not 70 billion. That's 140 billion a year, right? That's just simple math. So,
yeah, that 70 billion came from.
I know. I get all that.
But go ahead. But yeah, simple math. In the 100 billion range, maybe more.
Yeah, and that's the one thing I've been saying. And look, I wrote an article on this on the website as well. I said this is the one thing that could accelerate the recession, because again, that's an immediate drain of liquidity out of the market that people really. And this is the one thing that I don't think the market is given enough credence to. And as we talked about before, it's always these exogenous events that occur that create these problems and things that markets haven't really thought about yet. And I think this is one potentially that the market hasn't given enough weight to. And as we were talking about previously, is that, this was bad policy that started this. It created, this massive problem with price increases of college education. We didn't have that problem 2008, before the government got involved in student loan debt. You used to have to actually qualify for your loans. And all of a sudden, you don't have to do this anymore. And they had to be used for very specific purposes. And so now we've got this problem, $1.7 trillion. And now we're trying to figure out how to forgive it, right? So, okay, well, don't worry about the people that actually loan the money. Let's just give them the finger. Let's not worry about, contract law, which is a very critical component of economic stability. Let's not worry about the rule of law.
And democracy as well.
And democracy in general, right? So let's not even talk about that. But it's bad policy. And, the what we did during the pandemic, I get it. We were trying to give people relief while we artificially shut down the economy. But at the end of the day, this is going to have to come back around. And if the numbers are true, right? No matter how you kind of dig at these numbers, they kind of come out the same way. You're talking about a pretty significant hit to discretionary spending on a monthly basis. And, companies like Amazon and others, which we're long Amazon. So, we're watching this very closely. When all of a sudden the household comes up $300 short next month on being able to make ends meet, it's got to show up somewhere. And it's most likely not going to show up in their non-discretionary spending. They're going to have to make their rent payment. They're going to have to make their mortgage payment. They're going to have to make the car note. Otherwise, they lose their house, they lose their car. It's going to come down to restaurant spending, which, restaurants have been doing very well. McDonald's just reported very good numbers. Maybe I don't go out to eat as much at McDonald's or Chipotle or some of these other companies. Where that's going to be the first impact that you're going to see is a retraction in eating out and leisure activities and those type of things.
Right. And this is coming at a time where, household indebtedness continues to accelerate here, right? Coming out of the pandemic, we've seen these household debt numbers. The cost of that debt is the most expensive it's ever been, right? The highest interest rates we've ever seen on revolving credit so far. So these places are already pinched. And Lance, you cite the stat all the time about, the gargantuan percentage of American households that can't come up with like
$500,
$300, if an emergency should hit. And now they're all of a sudden going to have to start repaying $300 more every month going forward, right?
Yeah, no, I mean, it's amazing. I get a lot of emails from people and they're like, okay, I'm 25 years old and I want to start investing for my future. Great. First thing you're going to do is pay off all your debt, except your mortgage. And then you're going to start saving 30% of your income. And as soon as you say that to somebody, they're like, I can't do that.
I can't do it. Yeah.
And like, well, why not? Well, because my rent, my mortgage, my this, my that, my other thing. And this is why you have to pay off all your debt. So you can, save more money. But that also means that you can't, live above your means every month. That means you're gonna have to really knuckle down, live on rice and beans for quite a while, and really focus on getting your savings in order. And then hopefully what will happen is your salary will increase over time, and you'll be able to maintain your lifestyle, and the excess savings will be there to continue to grow, and you'll be able to increase your savings rate over time. But there's no get rich quick scheme. But we keep telling people to live beyond their means. We keep, enticing them to buy bigger houses, more expensive homes. And again, you want to fix the housing problem, right? Everybody's like, well, housing's too expensive. Okay, that's great. That's all a function of bad policy. Started under Clinton, went through Bush, went through Obama, and has progressed under Trump as well as Biden, right? There you go. All of them contributed to the housing problem, right? It's also a function of fiscal policy through. Oh, actually, I apologize. It also started. Yeah, let's go back. Yeah, Clinton and Greenspan, right? So it started with them because Greenspan was promoting adjustable rate mortgages. So all of a sudden, in the late 90s, we started to come up with this great ideas like, hey, we'll get two mortgages, 80%, and then a 20% mortgage to avoid PMI. So you really have to put that much money down on a house. Okay, if you want housing prices to come down, the only thing you got to do is lower demand, right? Immediately get rid of all mortgages except for a 30-year mortgage with a 20% down payment, and you have to have a 700 or better credit score to qualify. Housing prices will come down and they'll start to align with normal economic growth and inflation. That's just supply and demand. But you've got to get rid of these low interest rate, no money down, 3% down Fannie Mae mortgages that are allowing people to buy houses they really can't afford to start with, but that's what's keeping housing prices elevated. It's supply and demand.
Yeah, well, okay, so bad policy, again, interfering with the natural economic forces of supply and demand. No huge surprise there. One other factor that's in play here, though, that I find really interesting is I did have that interview this week that I've been telling you I was looking forward to with behavioral economist Dan Ariely.
Yeah.
Right. And as expected, super interesting, folks. If you find the topic of behavioral economics interesting, or if you are unfamiliar with it, you should definitely learn about it. Go watch that video. I'll put up a link to it here. Super duper fascinating, because basically the whole premise of the discipline of behavioral economics is that we would expect people to make exceptionally rational decisions around money because it's so quantifiable. We make incredibly irrational decisions, right? And so the student loan thing is so, I think, it's such a great example of behavioral economics where basically the borrowers were promised, hey, we're going to help you out. We're going to put a moratorium on your payments, right? And what buyers should have done is said, okay, understand it's a moratorium, great. I should be saving whatever I was going to spend towards my student loans, I should put in savings and just have it there for when my loans go back into repayment, right? No, that's not what they did. They just spent it, right? Then you started getting the narrative out there of like, well, hey, and we might even forgive this debt for you, right? And so, people said, well, great, then I don't need to save this money at all. I can just spend this money because my debt's going to get forgiven, right? Even though there were plenty of risks out there that this might not go through, right? And basically people have assumed that it was a guarantee, right? And that's one of the risks that humans are really poorly wired for. If there is a risk of pain, but it's not an immediate one, we discount it way more than we should. And if there's an element of uncertainty in it that like, yeah, it's probably going to happen, but somebody might come along and actually fix things for me, we discount it way more than we should. So this was kind of like both. It was like at some point in the future, your student loans we're probably going to go into repayment. But even though it doesn't seem constitutionally justifiable, the current administration is going to try to actually forgive that for you. The rational person should have said like, okay, well, there's uncertainty here. I should at least just save this money in case my loans go back into repayment. Nope, I'm going to buy another car, or I'm going to, go take that vacation, or I'm going to eat out or whatever. Right. So we're just really bad for preparing for stuff like this.
Yeah, and look, and it's just a consequence of bad policy decisions. Another really interesting one is that during the pandemic, we increased all these child tax credits, and to give people help with childcare. And that sounds like an awesome thing, right? So who would argue against a policy that gives people more money to take care of their children? Nobody would argue against that, right? It's a terrible policy.
In spirit, guys like you and I would say, well, okay, how is that sustainably afforded? But right. Different story.
Right. And since they did that, childcare costs have almost doubled.
Yeah.
Right? And exactly what you would expect, right? You get people, if all of a sudden, if I'm a childcare provider and I realize that people are getting, an extra $1,000 a month for childcare, what do you think I do with my?
You raise your rates, yeah.
I raise my rates, right? And so this is all part of these bad economic policy decisions. Look, here's the thing: as a voter, right? So you want to talk about your voter. Whenever the government is giving you something, it's bad policy. It's just almost always across the board. Bad policy, because the money's got to be generated from somewhere, and there's a knockoff effect every time the government gives you something. So if the government's giving you something for free, it's costing you, right? You're either going to have to pay for it through higher taxes, slower economic growth, or ultimately at the end of the day, higher costs, right? And inflation. And and this was the whole. You remember Stephanie Kelton, who had like 15 minutes of fame over months?
On MMT, yeah, yep.
Yeah, I don't know what's happened to her. I haven't heard from her in like a year and a half now. But MMT was tried and failed beautifully, right? Because you gave people a bunch of money and you had massive inflation. And everybody's like, okay, that's not good policy, right? So this is why we have to start going back to the basics of economics and how it works, is that whenever you're spending money that you haven't earned, it has a cost. Somebody's got to pay for it. And that somebody is anybody that earns wages.
All right, well said. I got to move on from us being cranky old men yelling at government policy setters to get off our damn lawn here, because we don't have much time left, and I do want to hit a couple of quick highlights, and I want to get to your trades, obviously. Sure. Let me share my screen real fast. So your colleague, Michael Leibowitz, wrote a really great article talking about how our national debt, the interest expense in our national debt is just not sustainable at these levels. Okay, all of a sudden I'm seeing this rotation through these charts. Let me put a pause.
Hit the pause button at the top right.
Yep, I got it. This is the chart I wanted. So what you'll see here, folks, is we've had this exponential increase in federal debt. That's no surprise. We've talked about this forever. But I want to direct your attention here to the blue line, which is the interest expense on federal debt. And you'll see it's just started doing a moonshot since the Fed has started hiking interest rates. And commensurate with that, look at the green line, right, which is tax revenues, which is actually kind of nosing over here at the moment here. So we've got the worst of both worlds. We've got a fast increasing interest expense line, and the tax receipts to pay that are actually not growing nearly as fast, to put it politely. So basically, I just want to get to the punchline of his piece, which was the Fed has got to get interest rates down, meaning it's got to kill inflation, right? So that it can get back to getting to lowering rates again. Because the current trajectory we're on, we're going to hit whatever wall we're going to hit fast. And so to slow that, it needs to bring interest rates down. And so, it's got to do what it's got to do in the very immediate term to kill inflation so that it can then bring those rates down. This is one of the reasons why I think Michael is so sanguine on U.S. Treasuries right now, which is that those rates are likely going to come down as the Fed has to bring interest rates down once it gets inflation under control. And therefore, if you enter the market now, you can get paid nicely, and then you can ride the appreciation of the underlying treasuries as the government eventually resorts to having to get interest rates back to low levels again. Did I capture it correctly?
Yep, absolutely right. And in fact, that little nose over in those tax receipts is actually a fairly sharp decrease in tax revenue, which is, here you go, drum roll please, a very pre-recessionary indicator.
Okay. One thing on that, though, because I'm sure
I've got an article coming out next week, actually.
Okay. And I appreciate you tossing me a bone here. That recession may be coming. This may be a sign of it. But is that drop, I'm just curious for folks that might push back, is any of that or any material part of that coming from the delay in, I know in California, because of the wildfires out here, they gave residents until October to file their taxes this year. So could it be the fact that income taxes that should have come in haven't come in yet from that?
That wouldn't account for the magnitude of the drop.
Okay. I didn't think so, but I just wanted to head that question off at the pass. Okay. So in our remaining couple of minutes here, Lance, before we get to your trades, can you walk us through the key takeaways from your recent piece on debt? Because you take this debt story and bring it further, basically to say, look, we may need to expect sort of lower economic prosperity in the coming decades because of this debt overhang.
Yep, I can do that. Let me grab a couple of charts here real quick. And okay, so basically, what the article's about is that we've had this massive surge in debt, and not just not just under the Biden administration, but also under the Trump administration, which increased by $9 trillion. Under the Obama administration, another massive surge in debt. I mean, we've increased our national debt by over $20 trillion just in the last 3 administrations. So, the unbridled spending that's occurring, as I said before, whenever the government says they're going to give you something, it comes with a cost. And that cost is either higher taxes, lower economic growth, or inflation. It's one of those 3 things, or a combination of those things. And, we keep talking about, I don't understand, we have this wealth problem in the country, and we have this problem and that problem. And what you have with all these social uprisings around the country, social justice, all this stuff is all a function of people just getting, we talk about these riots, that I have. It's like, well, at some point, everybody's going to riot. They're rioting already, right? They're upset. They just they don't know what they're upset about, but they're upset about something, and they're pushing back. And, because think about it, if everybody was doing well, right? If everybody had great incomes and everybody's wealth was good and life was great, nobody riot, right? I mean, everybody'd sit at home and they're happy and they go deal with their families, right? So people are lashing out for a reason. And it's because of what we've been doing economically for the last 20, 25, 30 years in particular. And, you can look at this chart. This chart goes back to 1900 and is basically deficits, GDP, and inflation. And you can see that really we didn't have any deficit. Even during World War II, the deficit was very minor. We had a little bit of a deficit starting in 1980 when Reagan was really trying to battle, surging inflation rates and trying to, kickstart the economy again. You saw a bit of a surplus there in late 90s, and that was basically an illusion because that was just simply the Clinton administration took money out of Social Security, threw it onto the income statement, said, oh, look, we have a surplus. And then that's why it went away almost immediately after. And then since then, we've just had a consistent run lower of just spending to try to keep economic growth somewhat stable around 2%. And of course, you see those two big blue bars to the bottom and that surge in GDP, which is now reversing. That's those stimulus drops that we did. So of course, if you're going to drop $5 trillion into the economy, you're going to get a boost in economic growth. Problem is, it's just not sustainable. And that's why we're now back to 2% economic growth. And that's just a function of the debt. But where do when you start talking about your tax dollars that you pay, and again, this is the whole problem that exists. And I have two partners, Rich Russo and Danny Ratliff, and they hate when I talk about Social Security because Social Security is a huge problem. And they're like, well, people depend on this for as much as 100% of their income in retirement. So we're always going to have Social Security. Otherwise, people will be stepping over bodies in the street and that type of thing. So Social Security is all going to be here forever. It's just going to have to be. Okay, fine. You can have that argument. Here's the problem with Social Security. Right now, we spend roughly 100 cents of every dollar that comes in tax revenue just to fund interest on the debt and social welfare. Everything else is paid for by debt. And as interest rates keep going up, and as Mike talked about a second ago with interest payments, that's eating more and more of those tax dollars. We're now over $1 trillion in interest service alone on the debt. That's $1 trillion. So if we raise $5 trillion in revenue in taxes, 1/5 of it just goes to pay the interest on the debt. The other 4/5 go to pay for Social Security. What are you going to do for the rest of the spending? Right. And we keep wanting to spend more money. We want to do 1.7 trillion in tax, Inflation Reduction Act. That's really not inflation reduction, but it's just spending on projects. That's great. No problem with infrastructure, but you got to pay for that with debt. That increases your interest service. So every time we want to spend more money, it's all in debt. But we don't think about the consequences of that debt and how it impacts things over time and how it impacts to the economy. Again, you can see the pandemic spending that came out. And we're still picking up, basically another, $1 trillion right now in just new debt. And this is as of the end of last year. So we haven't picked up the $600 billion in new debt that was issued this year just to meet the debt ceiling requirements. So that spike is even going to be higher in 2023. But again, as we start looking at this, we're spending $4.50 roughly of debt to create $1 of economic growth. That's unsustainable. And that's just since 2009, right? And since 2009, this chart, right? This is how much debt has increased since 2009 versus economic growth, right? Economic growth is up 30% in total since 2009. Since the financial crisis, when Obama took office, that's how much the economy's grown. That's how much debt's grown to support that little bit of economic growth. If it had not been for that debt issuance, we would actually have negative economic growth. That's the red line. That's debt-free economic growth. And so you can see just how much is required in debt just to sustain a small 2% rate of growth in the economy. What this chart shows you is the total debt versus the normalized structural debt level. If we go back to the 1950s and 60s, we were growing at about 8% on average in the economy. Savings rates were running about 8%. Economics was very healthy. The average household had about 60% of debt to their household net worth. So that was mostly their mortgage. They didn't have, maybe a little bit of auto debt, primarily their mortgage. Everything else they paid for in cash and had savings. Since then, if we used that kind of economically beneficial debt to income ratio, that's that black line running out that you got here. We would have to revert debt in the economy by over $30 trillion just to get back to a manageable, sustainable debt level that would create economic prosperity. And of course, the last time that we had some type of debt reversion like that was during the Great Depression. So, the problem with debt is the function that it erodes economic growth, it erodes inflation, It keeps us at a suppressed level of activity in the economy. 2% economic growth, mind you, used to be considered pre-recessionary prior to 2000. If the economy was growing at 2% pre-2000, we were worrying about a recession. Today, we're just hoping to get 2% economic growth. In fact, the Fed's long-term growth projection right now is 1.8% on the economy. At 2% growth in the economy, you only bring in enough activity to support the labor force. It doesn't account for the new entrants into the labor force. And this is why when you take a look at labor statistics, we've got 190 million, employable people in the economy. There's like 50 million people that aren't employed. We don't count them because they've fallen out of the labor force. But this is why you have this economic disparity within the economy. Now back to Social Security for a second, the problem there. Back in the 1940s, when Social Security was first put together, there were 16 workers paying in for every worker that was taking out. Today, we have the lowest birth rate in the economy since the 1940s. We have a lot of immigration coming in, but it's at the lower end of the working wage class. And we have less than 2 workers paying in for every worker taking out. And that number is going to get worse because of more and more boomers moving on to Social Security. So explain to me mathematically how, without massive issuances of debt, how Social Security is sustainable to keep paying out at the rate it's going, because you have a depressed economic demographic growth rate of contributors into that pool of funds. It's a problem. And basically it's about a $90 trillion problem that we haven't talked about yet.
All right. Well, look, before we move on from this chart, I just want to say I first started paying attention to this debt to GDP. We'll go back to the debt to GDP chart for a second.
Yep, sure.
It first started catching my attention back in like the mid 2000s. The first. So right as we were getting back to the peak of where we were in World War II.
Yep.
Right. Or I guess what is that World War? Yeah, that's World War.
World War II.
Well, whatever.
You talking about that big spike?
Yeah.
Yeah, that's heading into World War II.
Okay, heading into World War II, I guess. Yeah. But anyway, so when it got up there, back up there, I remember thinking, oh my gosh, we're at this massive extreme now. We got to prepare for the reversion, right? But it just punched through the ceiling, and it's just I think at this point it's making its way into the out of the gravity well of Earth out into just pure outer space at this point in time.
That's all right. We now know there's UFOs for real now. So there you go.
Okay. Yeah. Exactly. So our debt to percent of GDP percentage, that may be the first thing to contact alien life in a future distant galaxy, given the trajectory it's on. But I think you did a great job basically dispersing earlier. You said that some people think that you're just too bullish and you're just selling sunshine and seeing unicorns and roses everywhere. I think you just dispelled people from that opinion.
Yeah, no, I mean there's a lot of really bearish stuff long term. I am not optimistic on the markets or the economy over the next decade. Right now we're in a bullish mode, so we need to trade it as such. But over the next decade to two, it doesn't look great.
All right, and we're going to have to end it there, but that's a good way to end it, right? Which is because it really shows your true colors, which is, look, you're a guy who has a lot of concerns about where things are headed, but your job is to safely see your client's capital to the best future you can bring it to. And right now it's a bull market, and you got to play the market you have.
Yep.
So in terms of playing the market you have, what trades, if any, have you made over the past week?
So kind of go back a couple of weeks because some things have been going on. So over the last couple of weeks, we increased exposure to some of our big mega caps. Like we bought a little bit more Microsoft this week after the earnings. The stock got hit a bit. Came back down to the 50-day moving average, got a little bit oversold on a short-term basis. So we added to Microsoft. We previously bought Amazon and Google, added to those positions, Apple as well. So going into earnings season, we increased some of our exposures to the mega cap stocks. We're still underweight those positions. We're about 6% short on the NASDAQ where we should be. So we've got about 5-6% in cash still in our portfolio waiting to be allocated, but we need a 3 to 5% correction to get that last 5%. We're right now running about 55% exposure out of a 60% exposure portfolio. So likely if we did a 3 to 5% correction of the markets, we'll be at full exposure at 60. And then if the markets do recover from that, we'll probably go to 70% equity in a 60-40 model because we can overweight exposures in our portolios. But we did also have been doing some rebalancing. Like this week, we trimmed back on Costco. It got pretty overbought, so we trimmed back on that. We kind of rebalanced our positions in Abbott. We also added to our Raytheon position that had a really good earnings report. The earnings for Raytheon RTX Technologies was actually really good. The stock got hit almost 15% in a day. It actually finished the day down like 10% on their earnings report because they said that they're going to have to pay for a recall on their powder coating on some engines that's going to cost them, and they've already set aside the money for it, about $500 million, but the stock took about a $4 billion hit. So there's a big differential between what the actual cost is going to be versus the hit to their market cap. So we took that opportunity to add to that position as well.
Great. So it sounds like a lot of gardening this past week.
Yeah, there's a lot of gardening over the last 2 weeks.
Okay. All right. Well, look, just before we wrap up, we are sort of in the midst of earnings seasons right now. As the picture's becoming a little more clear for you, any key takeaways from it? Better than expected? About as what we thought?
Well, no, of course it's better than expected because we lowered earnings dramatically.
I know.
Yeah. So
So
it's millennial earnings season. Yes, we're all beating earnings estimates. We're all very happy. I think you got to pay attention to the fact that companies are reporting lower revenues. They're beating estimates, but the revenue on a year-over-year growth basis is lower. So again, that's just part of the economic cycle we're in. But if we're going to have this market sustain itself, we need to start seeing a pretty aggressive growth structure in top line revenue. Since 2008, we've had revenues grow. We've had earnings grow, but operating earnings are up by 400%, reported earnings up by 500%. Sales growth is only up 100% since 2009. So how you manufacture a 400% growth in earnings on a 100% increase in revenue shows you how much is going into, and this is in the article on the website that I wrote last week, talking about this how companies manufacture earnings. And there's a lot of charts and graphs in that about how companies fudge numbers, and there's some surveys in there about where the retail investor actually sits in terms of Wall Street's concern. Let me just give you fair warning, you're not at the top of the list, but that all feeds into the fact of how they can manufacture these great earnings numbers, but not really have revenue growth. And revenue comes from economic growth. So how do you get fantastic earnings growth in a 2% growth economy? You fudge the numbers.
Yeah. Which is why the top line revenue numbers are so important, because they are much harder to fudge, right? So they're giving us a truer sense of where things are headed. All right. Well, look, got to wrap it up here. I've been getting the side eye from my wife, who's been recording here. She is going to spirit me away because it's my birthday today, and I promised her that she could have me. Yeah. So thanks. So I got to go out and let my wife be nice to me, which is going to be fun. Yep. But in wrapping up here, folks, first, just a reminder, if you didn't hear it last week, we have locked in a date for the sort of senior care, senior living, end of life, everything around taking care of the seniors in your life, or if you're a senior, making sure that the last chapter in your life is as best of a chapter as you can make it. That free webinar is going to happen on Friday, August 25th at noon Eastern, 9 a.m. Pacific. And just in wrapping up here, as always, I think we did a really good job again this week, showing all the challenges that regular investors, like those of you watching, have in just trying to navigate what's coming on here, with a lot of the bigger concerns that Lance and I waded through, but also the fact that the market's partying right now, and if you want to be capturing some of that, you have to find a way to play in it that's prudent, right? So, anyways, if you've got a good financial advisor, we always recommend that unless you're highly experienced investing on your own, that you work under the guidance of a good professional financial advisor, but specifically one that understands all the issues that Lance and I talked about in today's conversation. If you've got a good one who's taking good care of you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and his team there at Real Investment Advice, then consider scheduling a free consultation with the financial advisors that Wealthion endorses. To do that, just go fill out the short form at wealthion.com. Only takes a few seconds, and these consultations are totally free, so they don't cost you anything. No commitment to work with them, just a public service these guys offer to help as many people position as prudently as possible. Lance, as we wrap up here, I'm going to let you have the last word. But before I do, folks, if you enjoy these weekly market recaps and just can't wait to get to the end of them to hear Lance's brilliance when he gives the last word, please do us a favor and support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. All right, Lance, the floor is yours.
No problem. First of all, happy birthday, my friend. So it's
Thank you,
great
brother.
to be, young at 39. I wish I was 39 again.
I agree. It would be great to be young at 39.
But look, I know I get a lot of emails, like I said, from your viewers saying, "Oh, you're too bullish." But trust me, I will be happy to be bearish again when it comes time to be bearish again. Yes, I'm bullish right now because that's what the market's doing. But when there comes time, I got plenty of bullish ammo sitting in the pipes right now. That when that time comes and we start seeing
bearish ammo, but
yeah, I'm sorry, I got plenty of bearish ammo. Yes. Plenty of stuff stocked up for you that when it comes time to be bearish, I will be amply bearish for you.
All right, great. And just to be super clear, Lance, there is zero pressure for you to be bearish or bullish. The only pressure I want to put on you is to call it as you see it, which I think you do a wonderful job of every week.
That's my job.
You're a grounding force here on this channel. And I think, again, I want to give you props. You were one of the few voices at the end of last year really preparing folks that things could change faster than they expected. And I think you did people a great service by really playing that role on this channel. So just keep doing what you're doing, buddy.
No problem. Happy birthday.
Right.
Enjoy yourself and give your wife a kiss for me.
Will do. All right. Thanks, bud. I'm sure she'd prefer one from you from me too. All right. Thanks so much, bud. See you next week. Everybody else, thanks so much for watching.